For a lot of farming families, superannuation is a secret weapon in succession. Done right, it can fund your retirement, keep the farm in the family, and help you treat the kids fairly. But a new tax proposed could change the rules and your plans overnight. So today we're going to dig into how the government's proposed superannuation rule changes could impact you. G'day. Welcome to the AgriCoach podcast for families on the land who want to grow their family's wealth and prosperity across the generations. I'm your host, Ben Law, and I'm the Financial Bloke. Welcome back to the AgriCoach Wealth and Wisdom podcast, the show for families who want more than just financial success. They want to grow and protect their wealth, strengthen relationships, and maintain their success across the generations. I'm Ben Law, the Financial Bloke, and today we're tackling a topic that could quietly disrupt a lot of well-laid retirement and succession plans across rural Australia: the proposed new tax changes to superannuation. If you ask most farming families what they think about when it comes to succession, they'll talk about land, stock, maybe plant and equipment, and ultimately what they're going to do with the farm. But here's the thing, super is often the unsung hero in the whole process. Done right, it can fund your retirement, take the pressure off the farm, and give you options for keeping things fair between the kids without slicing the business to bits. And that's why this new changes to superannuation matter most. It's not just about an extra tax, it's about changing the rules on one of the most important tools in your succession toolkit. If you've got a decent amount in super, or if you've got plans to use a self-managed fund or other super fund as part of your retirement, or even if you're just transitioning the farm, then this episode is for you. To walk us through the details, I've invited back one of our most popular and technically brilliant guests, Kylie Wilson. Kylie's a lawyer and partner at Sparke with decades of experience helping rural families navigate estates, tax, succession, and also self-managed super funds. She's an in-demand speaker and technical expert in estate disputes, and she's featured here on the podcast in episodes 17, 36, and 90. So if you haven't heard from Kylie before, I'd recommend go back and having a listen. Before we start though, we need to keep those bloody pesky lawyers happy with what we call a disclaimer. And here we go. The information contained in this podcast is general in nature and for educational purposes only. It's not financial advice. It's not legal advice. You should not act on the information without appropriate specific advice for your particular circumstances. I'm a former financial advisor, but choose to no longer be licensed and cannot and will not give you specific or personal advice in this podcast. So now that hopefully we've got the lawyers happy, let's get cracking. Kylie, welcome back to the podcast.
Thanks for having me back, Ben. Great to be here.
Yeah. Now, if you've been anywhere near the news lately, you've probably heard whispers or full-blown arguments, I suppose in many cases, about the new proposed tax changes. And we're going to have a good chat about that today, Kylie. But it's been pitched as a real hit on the ultra wealthy. I mean, that's how they're trying to sell this thing. But there's a lot more to it once you actually scratch below the headlines that are out there in the news. So before we get into the real nitty gritty, I want to just sort of start simple and just say, hey, in plain English, what are the proposed changes and what do you think the government's trying to achieve here, Kylie?
Well, I think your point's a really good one. It is extremely complex. There are a lot of issues that need to be gone through when you're looking at what may come in. And as you say, it's not in yet, and we're still to see what the final version of it might be. But essentially, it's an additional tax of 15% for members with superannuation balances over $3 million. Now, another thing to be clear about with that when we're talking about it, it's per member. So it's not if you have mum and dad's self-managed superannuation fund, we're not talking about the superannuation fund having a $3 million balance. It's the member balance. So it's calculated on a member's total superannuation balance. Now, what's comprised of that is where the calculation gets a bit complicated. So it's calculated on that for a financial year where there's an increase in taxable superannuation earnings for balances over the $3 million threshold and allows some adjustments for contributions and withdrawals. So when you're thinking of it and when it's been talked about, there's been some talk around it's a 30% tax on super. It's not. It's an additional 15% tax on balances over 3 million. And obviously that's if it comes in its current version. So that's the simple way of looking at it. Where it gets complicated is where we're looking at total superannuation balances and the actual formula. and there's a fairly complicated formula to go through. I think what people really need to understand about this is that it's not necessarily 15%. So your effective tax rate might be a bit different on the calculations. So if you have an amount that's a bit more than the 3 million, let's say, for example, you might effectively be paying tax at 6%, not 15%, depending on how you're calculating it. And that's something that, I mean, I'm a lawyer. I don't want to spend time going through the nitty-gritty details of a calculation, but I think it's really important, two really important things right off the bat. Firstly, it isn't in yet. And if and when it comes in, it is likely to be backdated from the 1st of July 2025, but you should still have some time to work out your tax planning. Don't put the cart before the horse. So superannuation is important, and there is still concessionally taxed superannuation. You need to actually get really good accounting and financial advice around what you're thinking about, what your options are with super, because sometimes if you're looking at, okay, I'm over what's happening with superannuation and I've had enough of what the government keeps doing with trying to access more money in super, there might be other taxation consequences of restructuring that might actually be worse than what the amount you might pay in tax if you end up or going to be over that 3 million. So I think there's an opening thing for people to think about. Don't panic. If you're concerned you're sitting up in that area where you might have an impact, get advice before you do anything. And you mentioned it's been advertised as a tax on the wealthy. I think that's, trying to make it look a bit glossier for the government, frankly. Over time, one of the big issues with the proposals at the moment is that there is no indexation on that 3 million. And I think over time, that's going to create a different scenario as far as where people's balances in super might end up. And there's actually if you don't mind, I'll read you a good quote, because this is something that Wilson Asset Management did a discussion paper on the 30th of May around this issue of what the tax might look like over time. And they've said that an alternative way to frame the lack of indexation is to work backwards. So if someone's 30 years old today and starts with a zero superannuation balance, by retirement they will likely exceed the $3 million threshold. It assumes a $100,000 salary that grows at 3% per annum, 12% contributions per annum, and a portfolio that grows at 8% per annum. By a retirement age of 67, they'll have a balance of just over 3.4 million. So over time, this is a potential tax for working Australians, not just wealthy Australians. So that lack of indexation is obviously a significant issue within the bill at the moment, as is the unrealised gain. And we'll talk through that. But I think the first point for people to understand is get financial advice and accounting advice around what it might look like for you if and when it comes in, because it may move a bit before it comes in.
Because I sort of see this people that are in three camps here, Kylie. There's those that have or are about to have over $3 million in their super right now. And as you pointed out, that's husband and wife or partners, it's per account. There's those that are coming up towards retirement and might be downgrading some assets or doing a succession plan that need to consider this. Then there's also the younger ones that are saying, okay, well, how's this going to impact me long term? Now, they're probably not thinking too much about it, but if you're coming back to a farm and you've got to do a succession with mum and dad, this is really going to be an important issue for you. So for everyone really needs to be sort of looking at this. And I do like your point about don't just throw the baby out with the bathwater. Back when I was a financial advisor, I started in the late 90s, and I remember this government was continually messing with superannuation all the time. And it was, as soon as the government got involved, there was just a raft of unintended consequences. But the thing is, over the years, they have gerrymandered it and changed it and made it more difficult. But it's still far better than the alternatives from a tax structure point of view. So I think I want to make sure people understand that you don't want to be throwing the baby out with the bathwater. So if we go back, Kylie, and look at this just from a really simple term. So do you want to just, for everyone who doesn't know, just explain how the current tax from a very, very basic level, like the earnings tax is, and then what they're proposing, just to keep it really simple so everyone understands? Yeah.
So I think the big issues are, and I think to be clear, I think most people and the public in general, the feedback on the legislation has been most people don't have a significant issue with a higher level of tax for large superannuation balances, because there are some very large ones out there, and that's understandable and not necessarily a problematic policy issue. I think there are a couple of issues. So at the moment, if you have you have a balance in superannuation, you will have, depending on the stage that you're at in super, you'll have accumulation account, or you might be in retirement phase, and that impacts how you're taxed. But if you look at it very simply and regard it as your income is generally taxed at 15% subject to tax balances and bits and pieces in super, that's the current situation. In retirement phase, you've got the transfer balance cap. So once you get over that particular cap that's gone up, and I can't remember what it is off the top of my head now.
A little under $2 million.
Yeah, around 1.9 something. So that's that component you can in retirement have without that tax consequence, but you've still got your 15% on income over that. This adds an additional tax. So we're talking about an additional tax that you only need to look at whether it will apply to you in two scenarios. So firstly, you have to have over $3 million in your total superannuation balance. And then secondly, in the financial year, you have to have had earnings on that. So it's the earnings on that.
So if you've got a shed or something like that, you've got your rent coming in off the shed. If you've got shares, you've got dividends or money in the bank account, you've got interest. It's just earnings on the fund.
Yeah. And it's similarly to what you would normally have in super. If you had dividends on your shares, you'll be paying some tax on that. If you've got, as you said, if you've got an investment property and you've got rental coming in, what would previously have been 15%, if your balance is over 3 million, you've got to look at the calculation to see if it impacts you. Now, that doesn't necessarily mean you'll have a significant tax consequence. That's where I say you've got to look at the calculation to see how it might impact you, because the calculation is complicated. I think the two really big issues in the bill that have been talked about a lot, there's been a lot of lobbying with the government, and frankly, the Treasurer's response on this has been farcical. But the two big issues are the unrealised gains, tax on unrealised gains, and the lack of indexation. So let's start
with indexation, Kylie. Can we start with that one? And then I reckon this is the smoking gun here, is the unrealised capital gains tax.
Absolutely. So the lack of indexation. So we just talked about the transfer balance cap. And I said, I can't remember off the top of my head what it actually is at the moment. That's because it's indexed. So it means
it goes up every year.
Every year, you get a little bit more of an increase on that. The big problem with this 3 million is that it won't be indexed. So if you think about that from the perspective of, you and I have talked about retirement planning for people for many years now, particularly in farming families. And people might have had advice 20 years ago around what amount of capital they needed to support themselves in retirement to be able to pass the farm on. And they might have had a genuinely good ability to retire at, say, 1.2 million. Over time and with cost of living, that's not necessarily the case anymore. And as we get further along, that's going to be even less the case. So if we're saying at 3 million, you start to get higher tax levels, that's where I said before, it's going to spread out further into the population the further we get along, because the amount that you actually will need to retire uncomfortably to be a self-funded retiree, that capital will need to be more to generate the income you need in retirement.
And generally everything is indexed, isn't it? Like you look at the contributions you can put in, you look at most tax rates, they're indexed. So again, just to reiterate for those who've lost us, is indexing just means it goes up each year with inflation. Yeah. So just like the cost of, I don't know, a McDonald's burger goes up every year, or a Coca-Cola, the rates that they charge you your tax on will go up each year. And and it doesn't take a rocket scientist to realise that 3 to 4% a year over the next, say, 15 years, that'll probably halve the effective limit.
Oh, look, and really, I mean, lack of indexation in a draft bill like this, where we're talking about an amount that will generate a different tax, is frankly just bad drafting in the legislation. I think the problem has been that, as I say, National Farmers Federation has lobbied about this, the Self-Managed Superannuation Fund has lobbied about this. They just aren't getting any traction on it. The Greens are actually trying to get a change that is, unfortunately, to some extent, $2 million, but with indexation. But $2 million starts to affect a lot more people, even with indexation. So there are some significant problems in this indexation issue that's causing concerns. And probably, as you've said, the bigger concern that sits within it all is the tax on unrealised gains.
Yeah, yep. Because I've done an episode before on the sneakiness of inheritance tax coming back in, and I think I've raised the flag that
this sits there. This sits there because the other issue that people have to consider is when they're looking at this, they absolutely need to revise their estate planning from the perspective of if there is the prospect that on the death of one of you, the other's total superannuation balance might exceed the 3 million. And that's if, for example, you're taking a reversionary pension, you need to revisit that.
And it's not hard to get over 3 mil, is it?
No. And as I say, not if you're looking at a situation where you might end up with one member who is going up because of the death of their spouse. So that's where you're talking about what we'd like to say a de facto death tax. There's an element of that sits in this legislation.
Well, I think also, Kylie, there's also the fact that they're messing around with unrealised capital gains, and we're going to define that really clearly. But I want people listening to remember this. They're messing around with unrealised capital gains tax within super that's going to affect, in inverted commas, a small amount of people apparently. And I think that's almost testing the water to be able to go, okay, well, if we roll this out in super, then we can roll out some tweaks around the edges to non-superannuation. And then all of a sudden, like the CGT, small business retirement exemptions, et cetera, they make a small tweak to that. And when you're talking with farming families where assets are transferring between generations or being sold, this could have a massive impact on the farming community. And
when you look at those concessions, they're already not good enough for farming families because that's one of the areas, again, where we don't have indexation. So where you look at talking about $2 million turnover as one of your thresholds in that scenario, $2 million in turnover is not what it was 20 years ago. So meeting the thresholds for those concessions to transfer things between generations is getting harder and harder, because you have to generate more turnover to pay your costs because your costs are increasing even if your profit margins aren't. So those things are problematic. And I think the unrealised gain concept is a very dangerous precedent in tax because essentially what it is it says, to put it very simply, let's say you have a part of your aggregation held in super and you might have acquired that in super because you had the funds there, it was business real property and you could at the time and it was the neighbour's property and you really wanted to buy it and you didn't have the funds elsewhere. That property is sitting in your super fund, and if you don't have much other liquidity, which creates different compliance issues, but we won't go into that at the moment, if that's one of your main assets in super, and basically what this bill says is if that goes up in value during the financial year, there's a tax issue. Which is
insane, just to make it really clear.
If you don't have the funds to pay the tax, what's your options? So you've either got to look at whether you can get the contributions in to pay the tax and you've got your caps around the contributions you've got to consider, or you're going to have to sell your asset. Now, I think that that's going to not necessarily impact a wide range of people at this stage because it will depend how far over and how large your asset. But farming families in particular, that may be an issue because we all know what's happened to rural property over the last 10 or 15 years. It's gone up significantly in value, and it generally does over a 10-year period. So if you're having to value that in super every year and it's gaining, and if it's under 3 million now, it probably won't be in 5 years' time.
And that's a real issue because, just to be clear again for everyone, if say you've got a block of land and that block of land is worth, I don't know, let's just call it $3 million, Kylie, for this example. Yeah. And on the 1st of July, and then 12 months from now, that's gone up to 3.5 million. Markets changed, not hard to do. Well, therefore, there's an unrealised capital gain. And so if you've got an asset that's worth 3 million, it goes up to 3.5 million, and you sell that asset, that's called a realised gain. And then the government wants their share of that increase.
But in that scenario, you've got the money.
You have.
Because you've sold the asset. That's why it's a realised gain, because you've realised the gain and you've actually got the funds to pay the tax. What an unrealised gain means is that you don't have the funds to pay the tax because you haven't sold the asset, but it's getting assessed on its change in value. I mean, I find that as a principle absolutely abhorrent and completely contrary to the entire philosophy of our taxation system.
Yeah, because that's how it all works outside of superannuation. I mean, and just this is a bit doomering, gloomering, but I think we need to really think about this stuff is you can imagine outside of superannuation, you play the scenario out. You've got your farmers worth, I don't know, $10 million, $100 million, whatever the number is. Let's say it's worth 10, and then a year or two later, I'll say a year later, it's worth 11 or 12 million. And the government comes in and says, oh, your farm was worth 10 million. We've actually valued it at $12 million now. You've got a $2 million gain. We're going to levy a 10% tax on that. That's 200 grand. Like, you can just imagine how crazy that sounds to people. But that's ultimately, this is like almost a litmus test or a potential where that could go in the future. And that's why.
Well, as I say, just a dangerous precedent, particularly in the context of, problems with budgets, with federal budgets. And this area of tax, both super and capital gains tax, is federal. So if we're looking at federal governments having issues with exactly where they need to get their funding from, I think bringing in a concept in super of taxing unrealised gains, as I say, is a dangerous precedent and something that should be scrapped altogether.
Do you think that's probably a difficult question to ask you because you're trying to guess what will happen, but do you think there is widespread pushback against this idea, Kylie, or are you seeing really widespread pushback against the unrealised capital gains issue?
I think there's widespread pushback against that issue. Industry groups, tax groups, the Tax Institute, whoever you like, everyone has pushed back on that. I think the problem has been the lack of response to the pushback on that. Now, keep in mind, I think the problem, and this is the danger sometimes in the way legislation is drafted, bill done essentially in a hurry while they're working through issues they can deal with for an election. They got back in and now they've got this bill that's probably not ideally drafted that they're still trying to push through. It would be nicer to think that, governments are voted in and we all, majority of Australians obviously voted them in. I think it's important that they still be listening to industry groups and people like the National Farmers Federation and everyone who's thinking about these long-term problems, because I think that it's the long-term problem that is the potential issue. But inside super in particular as well, we have enough issues trying to keep farms in families. It is hard enough to run a family farm and make a decent profit without adding further complexities. And I think sometimes that where we're looking at this global type of tax approach Australia-wide, sometimes the specific issues for farmers doesn't get looked at closely enough. And we all, as a country, need to remember that the backbone of this country is agriculture. And I think that, this complexity, I don't want people to be rushing into changes with their super without advice, but I do think that the problem with the unrealised capital gains tax is not something that's ideal at all, let alone for the risks for farming families that have an asset in super that's part of their farm.
It's interesting too, Kylie, like we're talking like it's going to impact farmers, but this is going to affect small business or family business owners all over. That's because correct. Outside of farming, I'd hesitate to say a very large percentage of family businesses will own, say, their business premises. So they've got a shop or a factory or something like that. The tradition has been to buy the business premises that they've got in the super fund, and then that's part of their retirement nest egg, and doesn't take long for those to build up in value, and that's exactly what's going to be triggered. And what worries me, Kylie, is people get these assets into super, and if they don't have, as you mentioned, liquidity, so other assets, it's just one big chunky asset, then the government does change the rules and comes in and says, righto, we've got this chunky bill, you've got to pay $70,000, $80,000, $100,000 or hundreds of thousands of dollars each year. You're not going to be able to pay it, then that asset's got to be sold. And what impact? So it's just not farmers, it's business as well.
Across the board. And I think lumpy assets in self-managed super have historically always been a problem and created some issues. And obviously they have to be generally business real property if it's business to be held in super. But some of the problems are things like what happens on death of the members, and you've got a lumpy asset in there and not a lot of other liquidity, and that can even imply with investment properties. So those things, there've always been issues with self-managed super and managing your super properly, particularly if you've got lumpy assets. This just adds another layer of complexity where you've got lumpy assets in super and you have to think about what advice do I need to assess where I might sit with my unrealised gain at the end of the financial year, and do I have enough liquidity to deal with the tax outcome? So the importance will be if and when it comes in and what it looks like when it comes in. If you've got, I say lumpy assets, really, it's what we're talking generally property type assets in super.
Well, you can't just carve off a little bit.
Yeah, and not a lot of other liquidity. It'll be important to get advice just to see what the impact on you is. It may not be as bad as you think it is, depending on the calculation. Depending on how large your asset is, it may be significant. But depending on what you have in super will be you need to really get the calculation done before the end of the financial year so that you can plan for what the outcome might be. There'll be more flexibility for people, obviously, who've met a condition of release if they want to look at changing things in super. But I'm not saying that.
So that's someone who's retired.
Yeah, I'm not saying that from the context that you should, because, again, you should get advice before you do, because don't rush out and pull something out of a concessionally taxed environment and find out that you've got a worse tax outside of super, basically. You need to have the advice before you look at those particular issues. The other thing to be conscious of in self-managed super and super in general with your balances is think about insurance. So TPD, you have a TPD event and you get a large amount in super, you need to get advice. So because that might push you over your 3 million, but if you are TPD, you've met a condition of release, you might need to think about whether that needs to come out of super or is it going to have worse consequences. And so again, advice, is it going to be worse inside super or outside of super, depending on where the balance is. So frustrating to add this level of complexity in super. I think that certainly it's something that, you can understand the position of looking at a further tax on large superannuation balances because there are some very large ones out there being very concessionally taxed. But I do think the two big issues where the problems lie is the lack of indexation and the unrealised gain problem.
It's interesting, Kylie. I did a podcast mini the other day. Your farm is not your super fund, because that's one thing that just, I've heard 1,000 times and I did the whole episode on it, so I'm not going to redo it. But essentially, off-farm assets, I'll put in general term, are really important for succession. Like I called it their superpower, but it's really important to build off-farm wealth because I've seen so many families get to the succession point of view and then it all fall over because there was no off-farm assets. So
not enough capital in retirement.
And so ultimately, superannuation and the off-farm structures are really important. And so whether you use super or a company or a trust or whatever your own names, but super's still really, really attractive to most people. But we need to understand that it's hyper attractive because the tax benefits are so amazing. The estate planning can be so amazing. The asset protection can be so amazing. We can't forget all those. But the thing with it is you need to get good advice, as you mentioned, because there are hairs on it. Your will, as we've talked about before, doesn't necessarily impact your super. So where your will is, you've got the concessional tax, but if you pull money out of super all of a sudden and say, look, I want to pull that money out to make a change, you might not be able to get it back in. No. You might leave it until you're 60 and say, we'll throw it all into super when we retire, it'll be okay. And then they go to the financial advisor and say, sorry, we can't get your money into super. You can't meet it. So it's really important that you actually start planning. And I sort of push people to start early, like real early. And so I'm within the families that are in our accelerator mastermind that I work with, we're pushing them to say the next generation needs to start building their wealth, because if you start early, you're going to have a lot more at retirement.
Much easier later. Much easier later. Yeah.
So
and this is a real look before you leap scenario, though. This legislation, this bill, is just, as I say, it's a real look before you leap. Because it's a really important point that you just made. Be really careful about jumping the gun and saying, I've had enough of what the government's doing, I'm just going to take things out of super, and then realise you're in a worse tax scenario outside of super and you can't get it back in. That might arise in certain circumstances. So the look before you leap, get the advice is really important. And it's across the board in this space because, as you've said, one of the issues that we've talked about many times over the years is that problem of having enough capital in retirement so you can actually pass the farm on to the next generation, with that farm still being viable for the next generation, because that's everybody's goal in that scenario if they can. Super will still, we are one of the shining lights worldwide for the ability to have developed self-funded retirees. So super's still going to have, concessional tax to a point, but you need advice around your planning in it.
So you do a lot of succession, Kylie, and have done it for a lot of years. Do you find that when people have zero superannuation or zero off-farm assets is probably a better term, anecdotally, is this a big issue that you see? Like it's a major stumbling block? And you just talk us through your thoughts on that?
Yeah, it very much can be. And then if you add on, there's still debt there as well. So because if you add, so let's say mum and dad have got financial advice and they need $2 million to be able to retire comfortably without relying on the farm. So next generation, if there's no off-farm assets, essentially would have to borrow $2 million so that mum and dad have enough to retire on and refinance debt if there's debt as well. And so that next generation then has to say, have I got a viable business if I'm doing that?
Yep, an extra 2 mil.
Yeah, and that's where it can run into problems because I think, and that's where I say the lack of indexation in this is an issue because most of the clients that I'm seeing first up, if they haven't had financial advice before and we're talking about can we look at transitioning during lifetime because it's a business and we should be looking at transitioning during lifetime, is you need financial advice to say how much capital do I need in retirement? And it's almost always more than they think it is. And that's where superannuation has been a good strategy for many in let's actually look at how we build our superannuation so that we have something to have a good income stream in retirement. It's an off-farm asset, makes it easier to transition to the next generation. It's only an off-farm asset if you haven't bought a part of your property in that super fund as well. So that's the other problem with rural property in super funds. If you're planning to transition to the next generation, the level of complexity associated with part of your property being in super, it just makes it, much more difficult because you can't transition that to the next generation. It has to be arm's length because the super rules require that, which means your next generation has to buy it from the fund on an arm's length basis. So if the business is still viable doing that, they have the cash flow to meet the borrowings, then maybe it's fine. But I relatively rarely see that we've got a farm that can actually support the level of capital needed in retirement if there's none at all.
It does make it a whole lot easier. And the common bit of pushback I usually get from most people is two, Kylie. Number one is they usually say, well, there's no cash flow left. Everything goes back into the farm. And I'm like, well, start early and start small. You'd be surprised how that'll compound over time. And the second one is I can make more money out of my farm. If I put my money back into the farm and, I trade cattle or I buy more land and develop it, I can make more money. And I'm like, yeah, you can. You totally possibly can. But the ultimate, at the end of the day, it's not always about the place of the best return. Sometimes it's just about providing more options for the family down the track.
And what's the long-term plan? Knowing what the long-term plan, we've had this chat. You can't determine anything in life without having a plan and knowing what you want. So what does everyone want? If you actually are planning to transfer it on to the next generation and you have a next generation that actually does want to take it on, because let's be realistic, if it's a farming family, you're working 7 days a week, 24 hours a day for 1.5 to 2% return, they've really got to want to take it on. But they actually want to do that, then you really need to think the earlier, and we've had some mutual clients over the years where we've had them starting in their 30s around what they're going to think about putting into off-farm assets because, they're thinking they've received this from their parents and they're thinking of themselves as custodians. They're not thinking of themselves as owners. So they're custodians, and this is going to have to be passed on to the next generation. Starting there about how they're going to retire is important. So this isn't just an issue for people who are looking at planning what they're going to do in the shorter term. This is the longer you plan, the easier it is.
Definitely. And I think that's true for the whole succession discussion, the whole preparing your next generation. Start early, get a plan, work out what you want to do, and then get cracking on it because to be blunt, most of the issues I see people hit when they hit 60 and they start talking about succession, if they'd have addressed it 10 years earlier, they wouldn't be problems. Most of them are fixable if you start early enough. And it's the same with this off-farm wealth. You start early enough, you can absolutely have enough to retire on. You just got to start early and get good advice.
And it's not even then that it might not be fixable if, in your older years, but it may be a little harder. And that's something that needs to be taken into account. And I think with this bill, in particular, one of the things for people to think about if they've got farms in super is if it comes in, what does that look like from a yearly tax basis? And even then, what's my long-term plan for the farm that's in super? Because if that's intended to fund you in retirement, then the likelihood is it will have to be sold. So is it being sold on the open market or are you going to have to sell it to the next generation? Does the next generation actually know that? Does the next generation actually know that if they're going to keep this, they're going to have to pay market value for it? Because if that's the case, they might be able to plan it early. You might be able to work with your accountant and your financial planner over some time to see how you can make sure that it's still viable if you're going to transition it that way.
Excellent. Well, that's good, Kylie. We could probably dig into the details for a day, but we don't want to bog everyone down with that. So I think that's some great information. I'm listening is basically be prepared. get advice early and take action. Don't shoot from the hip. I can't remember the analogy you used, but don't just all of a sudden, look before you leap.
Look before you leap.
Yeah, look before you leap.
Yeah.
Is there anything else you'd like to add in before we wind this up, Kylie?
Yeah, just keep an eye on what's happening with it, because as we say, it isn't coming in yet. It's not there yet. It hasn't gone through at this stage. There's still movement in the space. As I said, the Greens are looking at something different and lobbying for that. We can't really be 100% sure what the final version is going to look like. It is likely there will be a final version. It's just a question of what that final version is going to look like. So keep an eye on it, because what we're talking about now is there are a couple of big issues. There are complexities with the calculation, all of that sort of thing. There may be some movement in between that may change what you need to look at. But at this stage, certainly it's don't necessarily go, I've got things in super, I'm over my self-managed fund, I need to think about how I'm going to change things. I think the other thing for people to be conscious of, if they're, listening to this podcast and saying, oh, well, I don't have a self-managed fund, it won't affect me. If you're in a public fund, one of the big problems is going to be they're going to have to need to change all their programming for this calculation. So where do you think the cost of that's going to go? And that's going to go to all the members, irrespective of their balance in super. So there will be impacts to some extent for pretty much everyone with a superannuation balance in some way. But don't just go, okay, in my self-managed fund, I'm concerned about they keep changing things to get more tax. It's still a concessionally taxed environment, and you should get financial and accounting advice before you look at changing anything, because your outcomes outside of super might not quite be what we think they are.
Yeah, my bit of advice, Kylie, to people listening out there is we get a lot of people listening that are involved in industry associations. We've got a lot that work for the government, etc. And I just want to say to them, keep an eye on this. I think if this came in outside of super and they tweaked a few of the rules out there, this could have a monumentally disproportionate impact on farming communities and families. Yeah. We only have to look across at the UK as to what happened over there over the last couple of years, whatever the time frame was. It's catastrophic over there with the death duties that they've implemented over there to farmers and taken away the exemptions. We're staring down the barrel of this could happen. So if you're in an industry association, you're anyone of any sort of influence, make sure you start to talk to the right people and have this conversation, because
we can't afford it, Ben. The issue is we can't afford it. We are an incredibly lucky country that we have the ability to create most of what we need from an agricultural perspective, what we eat, et cetera, et cetera. We need to look after that. So, and, I think between COVID and the geopolitical climate, I thought we would have learnt that. This legislation tends to make me think we still haven't. And I think, I agree with you. It's really important that the actual nitty-gritty of who's affected, rather than just a global, this only affects the wealthy. Some people might regard farmers as wealthy because they have high-value assets. As I said before, the reality is often they're custodians, never realising the value of that asset. It is continuing on to future generations, and that needs to be considered a bit better when this type of legislation is looked at.
Yeah, I agree, Kylie. Couldn't agree more. It's interesting, just to tie this off, is I had a conversation about the UK tax rates on the death duties on farms over there with two young British men, mid-20s. They came over here working visas. They're working professionally over there. And I asked them, I said, what do you think about this? And one of them sort of was a bit, I'm not really sure, but it does seem a little unfair. The other one was full on, farmers should pay their fair share. Everyone else has to pay. When mum and dad die, the farm gets paid down there. They should pay their 20% tax on the value of that asset. Yeah. And the thing that shocked me was there was no understanding of this is where our food comes from. If we do this, the farmers are going to lose their farms. Yeah. Absolute disconnect. I would even go as far as saying disdain for farmers. Yeah. And so I want people to realise is that that's not the normal. People do care. But when we get into certain areas, there is an element within society that goes, farmers' assets are quite valuable. This is a place we could get some more income. Farmers are an easy target because they're politically not very strong these days. So we can't forget the fact that
you lose that might change. If you lose the family farm and suddenly your grocery prices triple, well, that'll impact all society. Everyone's already struggling with the cost of living. So as you say, it's important that there's always been a city-country divide, but it's more important than it ever has been for city to understand the impacts of things that make it harder for family farms to survive.
And I'm not going to open this can of worms, Kylie, but we only have to look at energy. I mean, we've some of the most expensive energy in the world at the moment, and we're supposed to be, and we've got an abundance of energy here. So I'm not sure that the powers that be are smart enough to realise that they're
realising the nitty gritty. I had a conversation. I think this is just an important example of where we're talking about people understanding the impacts and costs for farming families. Conversation a couple of years ago with a farming family that one of their crops is corn. Now, they're trying to negotiate with, I can't remember if it was Coles or Woolies, but one of them. They get 14 cents for an ear of corn. They're having a 12-month negotiation to try and get 15 cents. They couldn't get it. Do you know what that ear of corn was worth in the shop at the time? $1.50. The farmer's getting 14 cents. It's getting sold to the consumer at $1.50. Now, I know there's supply chain issues and et cetera, and all the rest of it, but you might have a high value asset, but if you're never going to sell it, generally the returns aren't that high value.
No, we've just got to make sure that the next generation understand where their food's coming from. So
exactly.
Awesome. Well, Kylie, thank you so much for that. Where can people find more about you online, get in contact with you because you are a tax expert?
Well, I'm fairly easily locatable. I'm at Sparke Helmore Lawyers, and you can track me down on Google or LinkedIn or email. Email's always the best way to get hold of me, but more than happy to talk to people who've got concerns about what's sitting around their self-managed super in particular. And as I say, if there's nothing else they take away, it is literally just don't panic. Actually get the maths calculation if you're sitting in that area to see if there is an impact at all. And if there is, how significant is it?
Awesome. Thank you, Kylie. That's been amazing. Anyone needs some tax advice, some estate planning advice, asset protection, etc., succession, Kylie can always reach out and help with that. So, Kylie, thanks very much for your help today. And back, I think this might be our 4th episode or 5th episode. So looking forward to the next one.
Hopefully people get something out of it, and it's just great to talk to you again.
Awesome. Thanks, Kylie. Well, I know that was a really technically dense episode, and I really appreciate Kylie coming on and shedding some light on the topic. Now, if you're relying on super for your retirement or succession plans, this should be an episode as a bit of a wake-up call for you. And for those who aren't thinking about superannuation or retirement plans, maybe this is a bit of a wake-up call as well to be able to go, okay, I need to go actually start thinking about superannuation or at least building off-farm assets to be able to fund your succession goes on. Now, these proposals might not seem like they're really urgent, but they do have a potential to create serious problems down the line, especially for farming families with long-term plans within superannuation, especially self-managed super funds. So if this episode helped you, make sure you flick it to your advisors you've got, your accountant, or even your kids, because now's the time to think ahead. So until next time, I'm Ben Law, I'm the Financial Bloke, and remember, it's more important who you are than what you have. I'll see you next time.